Okay, so what was the problem? The problem that I faced back in 2021 when I was first asked, University of Maryland said, "Hey, could you design a course about blockchain and this crypto stuff, right? From a CPA's perspective." They wanted somebody who could address how do you account for the things, how do you audit it, and what's the impact of blockchain on kind of the business world from an accountant's perspective. And so I undertook doing that. And in year one, I kind of tried to teach it, and I hit numerous problems where I didn't have standard definitions. I couldn't give people guidance of, well, this is a riskier asset, and so you would maybe perform more audit procedures around it, or, well, here's the accounting for these types, because as you all will know, there was no accounting standard in 2021. In fact, FASB hadn't even offered to take this up. They actually rejected it as there was any need for preparing a standard on crypto assets. We had the AICPA guide, which basically said indefinite lived intangible assets, impairment less cost, less impairments, which I think everyone at this point agrees doesn't make a lot of sense for most crypto assets. Maybe NFTs, but not most of the fungible crypto assets that we're dealing with if you're in Web3, right? So the cost plus impairment treatment was clearly not appropriate for every type of crypto asset. And I was trying to figure out, how do I give guidance around this stuff or teach a course where I have to talk about audit and system evaluation and, what a GL looks like and how you account for it and so forth in this like kind of absence of any kind of standard or real guidance, right? And so what I came back to was that when we're accounting for things, you have to be able to categorize what's happening, whether it's the thing that was purchased or sold, whether it's an event, a transaction that happened, something like that. You have to the first step in any piece of accounting is you take the event, you say, oh, this is a sale of a product, therefore, here's my transaction, right? Or I have now purchased an asset, or I received this asset in exchange for a service. So this is how I'm going to transact for this now. So we always have to categorize things. And so that's what I began doing with looking at crypto markets like cryptomarketcap.com and looking at all of these different lists, because there's back in 2021, there's tons of lists that would say, oh, there's 17 types of NFTs. And I would look through those lists and thinking from an accountant's perspective, and I would say, well, in this list of 17 things, I see two distinct types where I might have different accounting across these two types. And one because, well, this one has a shorter lifespan, and then this one has a really long lifespan. So that's kind of how this all started, right? Is that I needed some kind of standard way of communicating and teaching this material. So I started looking at, is it a resource? Is it an asset? Or is it a source? Is it a liability? Or is it some kind of equity? What's its lifespan? What's the source of valuation? Does it have a good source a reliable source of valuation? Do we have level 1 fair value inputs? Or is it more of a level 2 or a level 3? With DeFi, sometimes you have more of level 2 type inputs. What's the purpose of obtaining it, and what's the nature of use? Is this the ordinary course of business? Are you purchasing it as an investment to hold on and to appreciate in value? How are you using this asset? And what are the underlying assets and attached rights and obligations that go along with it? So those were some of the considerations. And as I went along, I was putting the different forms of the hierarchy in front of other people. But here's kind of like the history of development. In January 2022, over there on the far left of the screen, you can see initially I was looking at digital assets, and I always had that break between here's cryptocurrency and non-fungible tokens. And initially I was looking at it as crypto was like held for sale, held for investment, or a utility token. So I was originally kind of thinking about like the purpose of use. And I was thinking about kind of like how you account for securities, because back in 2021, there was a lot of talk of, well, crypto is kind of like securities and fair value would be appropriate. And so we were trying to work through that. From the very beginning, I always had ownership and authentication NFTs. And then ultimately, the ownership category got further broken out into 4 subcategories. In the second iteration towards the end of 2022, this thing was kind of exploding. I had added CBDCs because even though they aren't like a distributed blockchain style crypto asset, there's still something that gets lumped into that category of digital assets, right? But it's government issued, so it has kind of like a cash equivalent. I originally had a box for securities. And ultimately, we've determined, and you might ask me, well, why did you take securities off? Well, because, and this was in along the AICPA's guidance, their technical committee made it really clear to me, you can't have a category for securities. Makes a lot of sense to me now. Whether a crypto asset is a security or not is a legal determination, first and foremost. And secondly, we've seen from the Ripple case that it looks like we're going to have a legal precedent where it can be a security and then it can change to not being a security based on when it's sold and who's selling it and who's buying it. So that being the case, any crypto asset could be a security, basically, aside from CBDCs and maybe some DeFi instruments. Any of these could be securities during one piece of the sale, and then they could change and no longer be securities. So therefore, we don't need that in this taxonomy. And then we also kind of further kind of worked through these definitions. By February 2023, I was working with the AICPA's technical committee to kind of go through. We had then introduced a DeFi instruments category where I was thinking about commodities, which are largely derivatives and synthetics. And ultimately, we ended up with this. And this is what was published in the Journal of Accountancy. Now, you might ask, what does non-authoritative mean? Does that mean it's not reliable or something? No. Non-authoritative means that it's not officially issued by the FASB. It's not part of official accounting guidance. I don't think it will ever be considered authoritative. What we've seen with the FASB issuing their standard is they basically gave, 5 scoping guidelines of, the asset would fall under this standard if it meets these 5 guidelines, right? So I think the FASB is probably going to stick with that kind of scoping language, and I don't think you'll ever see kind of an official taxonomy. So this will probably remain unofficial, but it's still quite useful for being able to do various things that are necessary for day-to-day accounting or for teaching new staff and so forth. The taxonomy went through 6 months of technical review with the AICPA's Digital Asset Working Group. We had to make sure that what we put into the Journal of Accountancy was going to agree with what they currently had out as their guidance, and it didn't conflict with any of their planned updates in the coming year or so. It also had to agree with the planned FASB standard as well. I also put this in front of the crypto CFOs, uploaded it. We had a few working sessions talking through it, kind of throwing different unique assets at it and saying, where does this fit? How would you categorize this? There was a lot of kind of me putting it in front of different people, both accountants. I put it in front of lawyers. I put it in front of a lot of people who work in the crypto space. And I basically asked them, attack this, tell me why it doesn't work, right? And so this is ultimately what we came up with and where we ended. So let's start walking through the taxonomy. All right, so first let's go through CBDCs. So CBDCs issued by a sovereign government. This is legal currency, so it's going to be a cash equivalent. The balance typically cannot be withdrawn to cash, purely digital, and that's the distinction. If you look over on the right side, you'll see types of sovereign or fiat money. You've got 3 types: physical cash, paper money, digital cash, which is a digital representation of a physical cash balance. This is what most of us are familiar with working with, right? We have our digital balances. But at any point, I can go to a bank and I can say, up to my withdrawal limit, obviously, I can withdraw whatever that balance is, I can withdraw it into physical cash. A CBDC, on the other hand, is purely digital. You'll never be able to exchange it for paper money at present. Now, that doesn't preclude the fact that we may get design iterations in the future where you can exchange a CBDC into paper cash money. But so far, the countries that have implemented CBDCs, they're going purely digital. It's all cashless. The MBA class I'm teaching at Virginia Tech, I have about 85% of the class is from Saudi Arabia. And so I was asking them last night, what do you guys use? Because we were talking about internal controls and cash. And they were telling me that, yeah, Saudi Arabia basically uses the CBDC at this point. It's a digital currency. You use your phone, and there's very little cash. In fact, the government has, which they call the kingdom, so they're always referring to the kingdom. The kingdom of Saudi Arabia discourages any use of paper money. And so they have basically moved into a CBDC. A lot of countries within the Caribbean have also moved to CBDCs. And you can see all of these at the bottom link on these slides. The Atlantic Council, you can also just Google this if you're trying to see it. Fantastic tracker, which shows you 130 countries, the current state of their CBDC projects, why they're doing it, the motivation, and more information. So a CBDC is not true crypto because it runs on a government centralized and permissioned blockchain. It would be a cash equivalent. I can't see any reason why it won't meet FASB's definition of cash. You know, the big issue with crypto not being cash or cash equivalent was that it's not issued by a sovereign entity. That's really the biggest holdup there on being able to call crypto currency. That's why no one in, like, the AICPA will call it currency, which, it's kind of conflicting because the IRS over there calls it currency, but the AICPA won't. So I don't make the rules, right? The FASB's exposure draft on accounting for crypto assets excludes CBDCs. Makes plenty of sense because if this is cash, we're going to just treat it like regular cash. In your general ledger, if you are dealing with a CBDC, it may be advisable to have a separate GL account for tracking the CBDC balances, similar to how you would track, separate accounts for separate bank accounts, right? So this is a screenshot of the Indian rupee, the pilot CBDC for the rupee. You can find these from multiple countries, and it's basically showing you on this screen. I wanted to put a screenshot here because it shows you how you go about transferring and moving into having the Indian rupee, the e-rupee. And you can find these different projects all over the world. Now, major types. You've got two major types. There's commercial and there's retail. The commercial type is going to be used on the back end for settlements between central and member banks, not for public circulation. My understanding is that a lot of central banks are already using something that is effectively a CBDC. It's just not on blockchain. So moving it into a blockchain-based system would then classify it as a commercial CBDC. For the most part, unless you're working with a major bank, you don't have to worry about you don't have to worry about commercial CBDCs. Not something that average people are concerned about. Now, the retail CBDC, this is for public use as legal tender by citizens and businesses. Why use this? What's the pro? It reduces the minting, storage, and handling costs of paper currency, which is a lot. It's expensive, right? It costs the government quite a bit to manage that. The government doesn't really have a good feel for exactly how much. We don't have a precise number on how much currency is in circulation, right? We have very good estimates of what the money supply is, but I think there's like M1, M2, M3. There's like different money supplies, and I'm not an economist. Basically, pointing out it's a complicated process over there, right? Now, with retail, you have programmable spending, which pro and con of that. The pro is that you're going to have significantly more transparency in the distribution and use of government grants, benefits, contracts, and stimulus funds. It could aid in reducing fraud, waste, and abuse of government funds. It could aid in using more AI bots or bots that can review payments, can check do not pay lists. I live up here close to Washington, D.C. A couple of months ago, I went to an ACFE event, Association of Certified Fraud Examiners. And the special investigator in charge of reviewing the COVID funds and the PPP stimulus grants and funds and checks that were sent out, he was saying how they were running analytics and they found in the list of people that Treasury had paid, I think it was some 2 million payments went to individuals that were on the Treasury's do not pay list because they just skipped the step of checking the do not pay list in the rush to push payments out, right? And to stimulate the economy with payments. And so you had a lot of fraudulent payments. And now the government is engaged in this multi-year billion-dollar effort to try to claw back the money that they paid that they shouldn't have paid. And that's where you kind of look at a CBDC and say, maybe we could avoid this problem using a CBDC. Now, according to the IMF, a CBDC could exacerbate a run on the banks, or it could weaken the ability of the central bank to influence the economy, which is kind of counter to common wisdom out there, which says, well, if you have a CBDC, the government's going to control all your citizen assets. There's fears that it's going to make it where you have less privacy. And I really can't speak to that. It really depends on kind of the specific setup and the variables that go into building a specific CBDC. There's a lot of room for either providing more privacy or more government control. And that's the source of all the controversy over CBDCs. Okay, let's move into fungible crypto. This is the fun stuff, right? Now, fungible and non-fungible, I'm assuming everyone on this call is reasonably familiar with the difference here. The big difference that I always highlight to my students is that non-fungible tokens are always tied to an underlying object. It could be digital, it could be physical. They're always tied to an underlying object. This is different from a stable coin. A stable coin is asset-backed, but each coin is not tied to a specific dollar, right? It's not like one USDC goes to specifically this dollar. It's just generally backed. Whereas NFTs, the NFT is specifically for this file or specifically for this asset. Even identical membership NFTs can vary in market value, and even if they're an identical NFT, they're tied to a specific underlying membership number, or like an item number of some kind. So there's always differentiations there. Let's talk about fungible crypto, fully decentralized. Why is this an important categorization? The only coin that I personally would put in this category is Bitcoin. Now, Bitcoin being fully decentralized, some people would argue with me on that, and they have, about how, well, technically, the Bitcoin network is probably controlled by 4 major players, and you have the mining pools, which are very large and exert influence. That's an argument that you could have, and determine whether you think it really belongs in fully decentralized or not. In my opinion, I'll put it there. Now, the indicators of full decentralization can include developer is unknown or not involved in network management, the changing the blockchain or the asset smart contract operation protocols requires a majority vote by a quorum of asset holders or node operators, or the blockchain or smart contract protocols are managed through a distributed autonomous organization, a DAO, with no entity exercising significant influence. This distinction matters because a coin that is fully decentralized is a lower risk coin than other types of assets. So moving back to fully decentralized, this matters because of control and risk, right? A private issuer coin, there's more control by a third party over that coin. And so the risk of those coins is higher. The risk of Bitcoin, although it is a volatile asset, the risk of any party being able to unilaterally come in and make changes to the protocols that run the Bitcoin smart contract is a little bit lower. It's a little more difficult to push through changes. Okay. All right. And then moving over to private issuer. This is where the vast majority of coins falls. It's in this category. We've got utility tokens, stable coins, and other private issuer. These coins, developers remain heavily involved in private issuer coins. Very often you're looking at younger projects. Very often you're looking at younger projects with only the coin part deployed, and it's deployed in order to raise funds. anyone who's been in Web3 for any period of time is familiar with this. You have a young project, you want to start, let's say, an NFT marketplace, or you want to do a lending protocol. Very often, you'll have your native token, you issue your native token, and you get people to buy it while it's still illiquid potentially, in order to give you basically capital in order to fund development. And then eventually, that token becomes liquid, and you have vesting schedules and so forth where people can sell it. And then you basically create a market for your coin. This also includes mature blockchains with active management involvement, and Ethereum is a fantastic example. Ethereum is a utility token, in my opinion. And by the way, my opinion of where certain things belong, you can rely on that, or you can come to your own conclusions and say, well, I think Ethereum really belongs in this other category. But I think most of us are going to agree Ethereum is a utility token. The Ethereum Foundation remains heavily involved in the oversight and the operations of the Ethereum blockchain, in staking. Ethereum was built to be a platform for Web3 apps. And at this point, there's no indication that the Ethereum Foundation is ever going to really step back from their active role. So yeah, that's a great example of a utility token. And diving a little bit further into utility tokens, these are private issue coins that are intended for primary use on a specific platform or for a specific group. It doesn't mean they aren't traded on a market. All of these will be traded on public markets. But it means that there's a specific use for the token. So, for instance, Ether is the most well-known utility token. Its native platform is within the Ethereum ecosystem, but it can be traded, outside of that on public markets and used in DeFi and so forth. This includes all of your native tokens, your DAO tokens, your NFT tokens. There's a term that was being used for a couple of years, and now I've seen, like, for instance, CoinMarketCap used to have a category that was called NFT tokens. And the NFT tokens was basically developers that were mostly known for NFTs that were now issuing a token as well. So, like, Bored Ape Yacht Club is the best example, probably the most popular example of this. They issued ApeCoin. ApeCoin is primarily intended for use within their members-only, NFT holder, members-only DeFi lending protocol. However, you can trade ApeCoin outside of that protocol. They were calling it, CoinMarketCap had it classified as an NFT token. In looking at this, it's really a private issuer utility token. Same for DAO tokens, whether they're used to fund the DAO or they're used as voting. Those DAO tokens have a specific utility within that platform, and so they're a utility token. Most of these utility tokens are unlikely to move to fully decentralized at any point. They could move there. And that might be one of the changes, that might be one of the updates in, say, another decade, really. I really think it's going to be quite a long time, where we start to have different categories, where we shift them around, or we add some subcategories under fully decentralized. So let's talk about native tokens for a second. Now, this is like my opinion. Now, we all know that for every private issuer coin, there's an entity out there who issued the token for whom it's going to be a native token. Now, the term native token is most commonly used when we're talking about DeFi and CeFi exchanges and their tokens. The only well-known exchange kind of missing from this list here, Binance, Uniswap, Aave, Cake, FTX's FTT token, right? Coinbase is missing because Coinbase runs as a trust on a trust model as opposed to issuing a native token. I've been thinking a lot about this. How would you, if you were going to liken a native token to equity, how would you account for it? Granted, again, let me just disclaim this. This is my opinion. This is not official accounting guidance. The official accounting guidance, which FASB will have to issue, or AICPA will have to issue something because it's something that has to be addressed at some point. That could be in conflict with whatever I'm saying right now. So make sure if you're watching this as like a pre-recorded webinar down the road, check the internet, make sure we don't have updated guidance that from the AICPA or the FASB before you take any of this and apply it. So I think that it's like it's kind of like the equity of a company, but it's a little bit different. Its value often depends on the popularity and success of the project. It's excluded from the recent crypto accounting standard. It's similar to equity and often used for internal settlements, which is unlike stocks. So it can be used kind of like a currency in a way. It's used in ways that stock isn't used. And so my opinion is we need to make it its own special class of equity alongside stock and apply similar accounting where the initial sale and the valuation on the balance sheet would use an initial offering value very, very low, typically, like the value that's set when you first create the coin. So thousands, hundreds of thousands of a penny, very small value. And then you don't record it on the balance sheet at fair market value. You don't record unrealized gains or losses on the native tokens. And when you're buying the token back, you record it as a treasury asset at that fair market value. And when you sell it again, you record the excess over initial offering value to additional paid-in capital. So again, just taking stock accounting and applying it to native tokens. What was the problem with FTX? One of the major problems was that half the balance sheet of Alameda was the native token, right? That's what tanked FTX and made them have to close down withdrawals. Well, there was a few things that tanked FTX, but a big piece of it was they had this native token as half the balance sheet. And the tokenomics were also flawed. One of those other issues that tanked the exchange. If we were taking native tokens and not putting it into the balance sheet at fair value, you would be able to see a little bit more of the actual activity of the entity, and I think that might be more reflective of appropriate accounting. Feel free to disagree with me. Stablecoins. A lot of people use Tether and USDC, very, very popular stablecoins. I know that I'm recording lots of payments for our clients where they pay on chain, and USDC is by far the preferred currency, asset. So we've got two types, asset-backed, algorithmic. Asset-backed, I really don't need to probably explain it too much to this crowd. This is where you have that 1-to-1 ratio backed by fiat currency or another basket of assets. This is generally pretty stable and pretty good. There is some I'd say controversy over Tether and whether they are holding enough reserves to back their full circulation of tokens. Some people claim that the tokens in circulation far exceeds what's held in reserve. And then, that leads you into a whole separate conversation about proof of reserves, proof of solvency, which was a big conversation last year. But both of those have their flaws. Now, algorithmic. Algorithmic is a coin that is kept in check by a smart contract algorithm that mints and burns coin from circulation to maintain a specified exchange rate. Algorithmic stablecoins carry significant risk. Let me highlight this. Significant risk. If you are auditing something, if you are reviewing the risk level, if you're trying to do a risk assessment and the entity has significant assets in an algorithmic stablecoin, that could be a problem. I would not, me personally, I would not accept an algorithmic stablecoin as any kind of collateral. I would not do it. Why? Because of what happened with Terra Luna and the collapse of Terra, which set off the entire 2022 crypto winter and everything else that followed, right? And that happened because Terra basically had an investor that bought 85 million worth of their coin. They shorted it, and then they dropped it back onto the market. And that algorithm, the algorithm basically has to try to mint and burn based on what the current supply in the market is, right? If you flood the market, if you have a market run, if there's a rush of everybody selling, usually that will cause the algorithm to slip. So these have high risk. All right, let's see. We've got some more in the chat. What do we have in here? Okay, all right. So Taylor's just adding a little bit more on Okay. On FTT token. Yeah. They also held back like 90% of the supply of FTT. Yeah. So their tokenomics, very, very flawed, right? I could talk for like 2 hours on FTX. I've done presentations for the ACFE on FTX. Yeah. And also taught it in class. That was a fun class to teach. All right. So other private issuer coins. This is a category basically with the AICPA where we just said, this is the catch-all. For the two most notable categories out of private issuer are utility and stablecoin. The catch-all is other private issuer. This is where you're going to put your meme coins, your shit coins, your illiquid altcoins. All of that goes into other private issuer at this point. A lot of small projects with their illiquid altcoin where they're trying to get up and running, they're going to go into this other private issuer category. Other private issuer carries higher risk. There may be, if there's any changes to this taxonomy down the road, it will be that we have identified that there is a third category kind of forming out of this private issuer that needs specific accounting. The thing that most readily jumps to my mind that might be added to the taxonomy is wrapped tokens. They might be added under private issuer, potentially under DeFi instruments. And it's going to kind of depend. And then there's a whole conversation that you can have on how do you value an illiquid altcoin, because quite frankly, illiquid altcoins, whatever is listed as their market value is typically not the realizable value. And Taylor has a lot of thoughts on this. We've had some very interesting conversations in the water cooler. If you're not a member of Crypto CFOs, join for the water coolers alone. Great conversations, very thought-provoking. Have certainly helped me to kind of push along and develop my own thoughts around even this taxonomy. Okay, DeFi instruments. DeFi platforms are unregulated crypto exchanges with no central authority. DeFi makes heavy use of liquidity pools, which inform asset and exchange values. Liquidity pools enable you to move across chains and across different types of assets. This is where you get wrapped tokens and composite coins and all sorts of fun little creations. They provide borrowing and lending protocols as well without the need for an order book through the use of an automated market maker. An LP, now here's the important piece on this right here. An LP composite token where the value is based on two or more private issuer coins, in most cases, are also other private issuer coins. So if I have a pool with, let's say, USDC and Bitcoin, and out of that pool, it gets issued some kind of a composite BTC USDC coin, okay? Or if I have a BTC and ETH pool and I'm using it to basically issue some kind of wrapped Bitcoin in order to jump over to the Ethereum blockchain, those are all still private issuer coins. They are not DeFi instruments. You don't need to use derivative accounting for them. Okay, very, very important point. An LP could include DeFi derivatives, or the composite token could be a synthetic if one of the pool assets is stock shares or bond coupons. Let's move to the next couple of slides to explain what that sentence means. So we have derivatives and we have synthetics. Derivatives are where it's a future, an option, a call, a put. It's your traditional derivative instruments built on crypto asset pools. Use derivative accounting. That's the derivative pool right there. It's a separate little thing. You need to use specialized accounting for that. Synthetics. Synthetics are where you're taking a non-blockchain, non-crypto asset and representing it on the blockchain in order to be able to put it into an LP at a liquidity pool so that you can then create some kind of a composite token and trade based off of that, right? So this is typically at this point, and this really doesn't exist too much in the market to my knowledge. My understanding is right now this is really still very very speculative, and it's really in the pilot stages of kind of seeing, can we do this? Does it make sense? How are we going to use this ability? So, and synthetic is predominantly crypto coins backed by stock shares or bonds. So you're creating a coin that represents the stock share or the bond so that you can exchange stock shares and crypto. The DeFi instruments category, this is for your day traders, your professional traders, where you need to kind of separate out some of these unique coins so that you can evaluate or apply separate or different accounting from other types of coins. And for the synthetics, right now, use your judgment and apply the best accounting that you can. Because most synthetics are backed by stock shares or bond shares, you probably can apply a lot of like fair market value type principles in order to account for these. Okay, what's the Q&A here? Let's see. Do we have anything else? Do you view USDC on deployed Ethminet versus some other chain like Polygon as the same? Yeah, I do. USD, I look at basically what I'm looking at is not necessarily where it's deployed, but what is the token. So USDC, whether it's on the Ethereum mainnet or if it's on Polygon or if it's on another chain or Arbitrum, whatever it is, I would call it a stable coin. It's an asset-backed stable coin, period. And the idea with the taxonomy is to give people basically those classifications so that we can all have that standard conversation when we're talking at a reasonably high level about different types of assets. Okay, let's dive into NFTs. Now, NFTs actually went into the Journal of Accountancy in an article in October 2022. So this predated the July 23 article with the full taxonomy. Essentially, I developed this little piece of the NFT piece with Peter Rim. It was one night in April. I called him up and I said, I've got it, Peter. I've got it. I got the 4 types. I know what the 4 types are. And we went through it, and he was very resistant at first. And so we argued back and forth for, I don't know, a week, 2 weeks or more about what it ought to be. And finally, ultimately, I was able to make the case that there are 4 types of ownership NFTs, and this makes a lot of sense for accounting for these NFTs. And then from there, I went and kept developing the rest of the taxonomy and ultimately brought it back to the AICPA and said, hey, what would y'all say if we published an article with this full taxonomy? And they were on board for it. So, all right, authentication versus ownership. Biggest distinction here, authentication is the blockchain without the crypto, okay? Well, we want to use blockchain to track X, Y, or Z and, see where it's going, but it's going to be valued in fiat, right? This is an authentication NFT. It's when you're using blockchain for its validation, its authenticity, its tracking purposes. That's when you have an authentication NFT. IBM and their Hyperledger, most of the stuff, if not all of the stuff that they've built on Hyperledger, is all authentication NFTs. Supply chain NFTs are a great example. So if someone says it's an NFT, it's on chain, and you see the valuation and the value is all in dollars, and you can buy and sell the asset in dollars, then you're just like, this is not an ownership NFT. It's an authentication NFT. Ownership NFTs bought and sold with crypto. This is blockchain with the crypto. It's providing proof of ownership. It enables Web3 immersive virtual world experiences, individual avatars, owned digital items. It has standalone market value. An ownership NFT is, there's some categories where you can expect to buy them as a collectible, or you're buying them for the purpose of, seeing the value go up and appreciate, and then to sell it for a profit. It very often includes a royalty clause, and it's more likely than an authentication NFT to be considered a security. Now, FASB hasn't issued any guidelines for how to account for NFTs. My suggestion is account for an NFT based on the underlying asset type, which for most of these types of assets, we already have accounting that will work for them. Single use, limited use, little to no resale value. This is something where you buy it, it's a ticket, it doesn't transform. It's a single-year membership. It's a digital award or a badge. POAPs, any of you going to F Denver, you collect all your POAPs as you go around. Doesn't really have any value. You can't really resell that. A semi-fungible token, now semi-fungible token collections, they could have both single-use and reusable in the same collection. Single-use, again, low value, low resellability, or no ability to resell it. Gaming items that are only usable on one platform. Most single-use NFTs are going to be used by individuals, and it won't be something that you have to be worried about as a business. From the business side, you might be issuing the single-use NFTs, and so if you're issuing them, you're not going to have the royalty clause, right, which would affect valuation. The value of that single-use NFT, if you're the issuer, is going to be the sales price that is initially paid and nothing more. Ownership NFTs. This is the biggest category. This is what everybody's familiar with. This is the art, collectibles, avatar, JPEGs, the digital fashion, the profile picture ones, music, and much more. Most NFTs fall in this category. For these, I would suggest intangible asset and impairment accounting is probably more appropriate than fair value accounting. But we can have a in-depth conversation about why that's the case. With ownership NFTs, you have resale value. The passage of time does not impair the value; it may even increase it. Royalties clauses are very common, and a lot of them have physical components. Now, you have to distinguish this from a real asset NFT. Does the NFT merely represent ownership of the physical component, or is it a physical piece that comes along with the NFT? That physical piece might not be resold when you resell the NFT, so that's something to consider. It might include perks. In fact, a lot of them do, particularly if they are representing membership of some kind. So it could be access to events, access to clubs, either digital spaces, virtual clubs, or physical places, member-only websites, merchandise, discounts, etc. And so when I talk about valuing NFTs, what I try to educate practitioners on is that if you have an ownership NFT, it's not just the market value of the NFT. You've got to look at all the other perks that go along with this NFT, and you might need to include that in the valuation of an NFT. For accounting purposes, you're probably only recording the market price or the purchase price in your records. The valuation piece is more important for like forensic work in a divorce case, litigation, where you're trying to see what's the actual value of the assets. In that instance, I would say don't just look at the cost of purchase or the current market price. I would look at all the other perks. Had they expired? Can they still be used? Do they transfer? And so forth. Perpetual NFTs. So this is a screen snip from Decentraland parcels for sale. Perpetuals are things that represent primarily digital land or domain names. An NFT, by the way, an NFT tied to real property, physical real property, that is a real asset NFT. It is not a perpetual. Perpetual is a digital land or a domain name. It represents locations on the internet or in virtual worlds. It may meet the definition of an indefinite-lived intangible asset under GAAP. I think it does, personally. Many parallels to websites and some perpetuals are web domains. And perpetual NFTs have been used as collateral in DeFi, and they can also be purchased through traditional mortgages or leases. The Ripio Credit Network offers mortgages on Decentraland land. So that's the future, I guess. I really think that Apple and what they've done with their new little VR goggles, wherever they go with that, I think that will have a big impact on perpetual NFTs in virtual worlds and augmented reality. Ownership NFTs, this is what everyone talks about tokenizing. We're going to tokenize it, or tokenization. And this is where you have a real asset and you're representing it on chain as an NFT for the purpose of making transfer easier. What distinguishes this from an authentication NFT? For a real asset NFT, the value is in some kind of fungible crypto. If you have a real asset represented on a blockchain and it's valued with fiat, I'm looking at an authentication NFT. You're just using blockchain for, its ease of transfer type purposes and the kind of like the escrow agent type purposes that a smart contract can offer. A real asset NFT typically is used to simplify ownership, to reduce associated fees. Look at Roofstock on chain. To fractionalize ownership across a larger group of people. So a lot of DAOs use fractionalized NFTs, or they use NFTs in order to fractionalize ownership, or to crowdfund and manage usage via a distributed autonomous organization. And then the Toko network is kind of interesting because the Toko network provides the service of they will tokenize anything for you. They'll tokenize real estate, art, music tracks, intellectual property, other real assets. So essentially what you do is you take the real asset, you represent it in a digital form of some kind, right? And then, which could be as simple as a document that kind of describes it, or some kind of parameters that go into the smart contract, and then tokenize it and distribute it along however many owners that you want to permit to own it. So, conclusion, the taxonomy is a tool. I can't believe I'm actually going to finish on time. I have sped talk for a lot of this, so my apologies if I was moving a little fast. The taxonomy is a tool for educating people new to crypto. I use the taxonomy in the class that I was teaching at University of Maryland. We start with 2 weeks, not 2 weeks, but 1 week and 2 classes on blockchain, cryptography, consensus mechanisms, mining. And then the third class is the taxonomy, because in that class, I had 7 weeks to take people who start going with not knowing what blockchain is and not really understanding crypto. I've rarely had more than one person who has owned crypto or has a crypto wallet in those classes, right? And you would think it'd be different with some of the younger generation, but young accountants, very risk averse. They're like, I don't know about this janky new crypto stuff, right? So they tend to avoid it. I've got to go in 7 weeks. I have to go from they have zero knowledge of this stuff to at the end of 7 weeks, they can talk fluently about it. They can perform financial statement analysis over it. They understand the fraud risks. They can analyze a general ledger or a system that is using crypto and talk to a client about crypto, right? And so to get them to that point, I use the taxonomy in order to help them become rapidly acquainted with the crypto market, right? If I can say, what's this asset? And they look at the taxonomy and they say, okay, well, this looks like this is going to be a reusable NFT. Okay, I already have all sorts of characteristics that are going to apply to that type. And so it makes it a lot easier to kind of organize your thoughts, to develop a risk matrix, to figure out maybe how do I want to organize my chart of accounts? How do I want to maybe do an audit plan? With an audit plan, you can use this to kind of say, all right, well, my algorithmic stable coins are higher risk than the asset backed. So I want to do more procedures around those and their valuation, right? And I think that the taxonomy will evolve as new guidance or standards from FASB are issued and as the markets develop. Particularly the DeFi categories may be expanded or revised, and there may be more refinements under private issuer, like maybe we add a separate category for wrapped tokens. It's really going to depend on what FASB issues as their guidance for wrapped coins. I don't think the NFT section will change much, but it could, depending upon how markets develop, how the future goes with VR, AR, and what FASB's guidance is if they ever do issue guidance for NFTs.